To get his take on oil, I sat down with Rick Rule, chairman of Sprott USA Holdings. Now, in this segment, I first asked Rick what happens to capital investment in the energy sector when oil prices are this low. Take a look at what he had to say.
Capital is going to become much more expensive. The very cheap debt that the industry has been allowed to gorge on, both in terms of the junk markets and in terms of the conventional credit facilities, is in the process of drying up now. Evergreen revolving credit facilities are going to be termed, which is a different way of saying that there isn't going to be more credit available to the industry. The declining share prices are going to raise the cost of equity capital at the same time that operating margins, ex hedges, are going to, in many cases, decline by 75%. This is an industry that has for 10 years gorged on cheap capital, and that competitive advantage has come to a screeching halt.
And what about OPEC? You know, Qatar has recently said that it won't cut production even at $40 a barrel. So isn't that bearish for oil?
It is. One of the interesting things that Americans have to face is that for 10 years or for 15 years, we have, many of us at least, the big thinkers, have suggested that the Arabs were in some way, shape, or form responsible for higher oil prices. The truth is that during the period of high oil prices, the Saudis, the Kuwaitis, and the Emiratis invested tens of billions of dollars to increase their productive capacity. And it was, in fact, those very heavy investments in the face of production declines from places like Mexico, Venezuela, Indonesia, Peru, and Ecuador that allowed us to constrain the upside in oil prices in the $110 to $115 range. In fact, the Arabs became our best friends. And the Arabs are now swing producers. They, I think, and I don't want to speak for them, but I would suggest that they didn't want to give up market share to protect a $100 a barrel pricing umbrella to let less efficient producers like the Iranians and frankly, like the U.S. shale producers, enjoy that pricing umbrella and strand $50 or $60 billion in capital that they had put in place to increase their own productive capacity.
Rick, Spain's Repsol is buying Talisman Energy for $13 billion. Now, that's Canada's fifth largest independent oil producer, and we already saw Baker Hughes and Halliburton getting together in the oil services sector. So are we likely to see more consolidation as the oil prices turns down?
I certainly hope so. The consolidation is useful in many ways. First of all, the industry needs to lower its general and administrative cost as a percentage of production and as a percentage of revenue. And hopefully these consolidations will eliminate most of one management team, which is a good thing. The second thing is that making capital allocation decisions across a broader asset base can and should lead to better investment decisions against more different competing sort of projects. And the third thing is that traditionally larger entities have enjoyed lower costs of capital, and lowering the cost of capital as a percentage of total revenues is also a very important thing. So I would suggest that these amalgamations are very good for the industry. And I don't think that they're anti-competitive. The oil and gas business and the service businesses are extraordinarily large businesses and extraordinarily fragmented businesses. And I think an awful lot more consolidation can take place before anti-competitive pressures as a consequence of size begin to kick in.
How much institutional memory is there in places like back in North Dakota where shale is getting tapped? And I ask this because they are new to the oil boom, where producers in Texas have seen several boom-bust cycles.
Well, I think institutional memory, unfortunately, is very short. And I think that occurs for a few reasons. If you're speaking in particular about investment institutions, many of the institutional managers run other people's money as opposed to their own. And they're fee chasers, which means that they sort of flit from hot cycle to hot cycle. But the industry's memory is very short, too. One's expectation of the future, unfortunately, is set by one's experience in the immediate past. And if you're experiencing the immediate past going back 4 or 5 years has been good, you tend to become more aggressive. It's a natural human tendency, one that I unfortunately have fallen prey to a couple times myself, to confuse a bull market with brains. And $100 oil leads some people in the oil business and also some of the institutional analysts to confuse the bull market engendered by high energy prices with their own acumen. We're beginning to see that come apart now.
That was Rick Rule, chairman of Sprott Holdings.